Welcome to Griffonomics.
Glad to be here for this one.
Yeah, and whether you are prepping for a high-stakes finance meeting later today, or you're just, insanely curious about how the actual machines of Wall Street work behind the scenes, you're in exactly the right place.
Absolutely.
Today, we're taking a really granular, investigative look into a firm that has essentially engineered a business model designed to win. And I mean, win whether the broader economy is absolutely booming or completely crashing.
Which is incredibly rare.
Right. The company is Houlihan Lokey, ticker symbol HLI. We are pulling from a massive stack of sources for this deep dive today. We've got their latest financial filings, the Q3 2026 earnings call transcripts.
And just to clarify, that's the quarter ending December 31st, 2025.
Exactly, yeah. Along with several recent analyst reports and a really fascinating interview with an enterprise AI innovator. The goal here is to unpack their fundamental business architecture, their aggressive strategic pivot into AI data monetization, and ultimately figure out why a firm with seemingly perfect long-term catalysts is facing some real market skepticism right now.
It is a phenomenal case study in structural resilience, really.
Yeah.
I mean, we are looking at an independent investment bank that operates much more like a highly specialized professional services company rather than a traditional Wall Street behemoth.
Right. They aren't structured like the bulge brackets.
No, they've intentionally designed their exposure to market cycles. They've built an architecture that essentially acts as a natural hedge against the inherent volatility of global finance, because historically, as you know, it's a notoriously boom or bust industry.
So let's start with the playing field they've chosen, because when most people hear the phrase investment banking, the immediate image is the massive multi-billion-dollar mega mergers, right?
The front page of the Wall Street Journal deals.
Exactly, the ones handled by the bulge bracket banks. So why would a firm intentionally avoid fighting over those massive, highly lucrative transactions?
It really comes down to volume and predictability. Those massive, headline-grabbing, large-cap deals, they actually only make up about 1% of global deal volume.
Just 1%.
Just 1%. I mean, they are incredibly lucrative, yes, but they're also highly volatile and subject to massive regulatory scrutiny. So Houlihan Lokey just leaves that volatile 1% to the traditional bulge brackets.
They just walk away from it.
Right. Instead, they completely dominate the mid-cap market. We're talking about transactions under $1 billion. That mid-cap tier accounts for roughly 98 to 99% of all global deal activity.
Wow.
Yeah, so they're casting this massive net across the entire ocean rather than, trying to harpoon a single whale.
But how is that massive volume actually processed? Because I know they have a specific segmented structure to handle this kind of load.
They do. They divide the firm into three primary business pillars. First is corporate finance, and that generates about 65% of their total revenue.
Okay, so the majority.
Right. This handles classic M&A advisory and capital solutions. And they are actually the #1 most active M&A advisor in the entire United States right now.
That's huge.
It is. The second pillar is financial restructuring, accounting for 22% of revenue. In this space, they are the #1 most active restructuring advisor in the world.
In the world?
Yeah. Just to give you a sense of the scale here, since the year 2000, they have advised on 12 of the 15 largest bankruptcies in the U.S.
That's a crazy market share.
And then finally, you have the third pillar, which is financial and valuation advisory, or FVA. That brings in the remaining 13% of revenue. That's mostly providing independent valuations and fairness opinions.
Which are essentially those third-party validations that a deal's terms are fair to the shareholders, right? Having those specific pillars totally makes sense on paper, but how do they interact to create that natural hedge we mentioned earlier? Like, how does this setup actually protect them when the macroeconomic environment shifts?
What's fascinating here is the structure itself is the hedge. Think about how these different services respond to economic conditions.
Okay.
When the market is booming, capital is cheap, optimism is high, their corporate finance and FVA segments are absolutely thriving. Companies are merging, founders are selling, and those highly cyclical businesses just print money.
Right. Everyone's getting rich.
But when the economy collapses, credit markets freeze, M&A activity dries up, that revenue stream obviously takes a massive hit.
And in a traditional bank, that means layoffs.
Massive layoffs,
Yeah.
blood in the water. But for Houlihan Lokey, that exact same macroeconomic pain causes their counter-cyclical restructuring segment to kick into overdrive. They pivot. They go from advising companies on how to grow to advising them on how to survive, how to restructure debt, or how to navigate bankruptcy. This architecture actively smooths out their earnings across volatile economic cycles.
So it's essentially a portfolio where your bonds automatically convert into aggressive growth stocks depending on what the market is doing.
That's a great way to put it.
But that covers macroeconomic shocks. What about internal shocks? I mean, traditional investment banking is famous for its massive rainmakers.
Oh, these star bankers.
Yeah, those individuals who bring in giant chunks of a firm's revenue based on their personal Rolodex. If that star gets poached by a competitor, the revenue just vanishes overnight. How does Houlihan Lokey protect against that kind of ego-driven volatility?
They rely on a very specific institutional metric to cap that exact risk. They operate with a strict internal threshold, where no single individual and no single transaction fee accounts for more than 2% of the firm's total revenues.
Wait, 2%. That's a hard cap.
That's the cap. By hardwiring that into their operations, they force a deeply collaborative, partnership-based culture. It ensures the institutional machinery is always more valuable than any individual operator.
So nobody gets too big for the firm.
Right. If a senior managing director leaves, sure, it might sting a bit, but it mathematically cannot destabilize the firm.
And looking at the recent financial realities, that machinery seems to be operating exceptionally well.
Very well.
Let's look at the Q3 2026 review again, ending December 2025. It shows some incredibly impressive numbers. Revenue jumped to $717.1 million. That's up 13% year over year.
Solid growth.
And their adjusted diluted earnings per share beat expectations, coming in at $1.94, which is an 18% increase. Plus, they're operating with what looks like a fortress balance sheet.
It really is.
They're sitting on $1.18 billion in unrestricted cash and investments, and they carry zero outstanding debt on their $150 million revolving credit facility.
Operating with a capital-light model and zero-drawn debt is exactly what provides the strategic flexibility to navigate the cycles we just discussed. Furthermore, management is showing significant optimism regarding the current macroeconomic cycle.
Yeah, I saw that on the earnings call. CEO Scott Adelson used a baseball analogy, right?
He did. He framed the broader M&A recovery around massive pent-up demand, specifically from private equity sponsors.
Because they've been holding on to portfolio companies longer than usual?
Exactly. They desperately need liquidity events to return capital to their own investors. Because of that structural pressure, Adelson estimates the broader M&A cycle is only in the third or fourth inning of its recovery.
But let's dig into those Q3 numbers a bit deeper, specifically the restructuring segment, because there seems to be a bit of a mirage there.
There is.
Restructuring revenue surged 19% in Q3, up to $156.3 million. On a spreadsheet, a 19% surge looks like a massive win for that division. But management was very transparent that this wasn't purely organic growth.
No, it wasn't.
It wasn't indicating a sudden boom in the distressed market. So what actually happened there?
The transaction timelines were significantly altered. That 19% surge was largely an anomaly driven by accelerated deal closures.
Meaning they closed deals early?
Right. Several major restructuring transactions that were originally slated to close and generate revenue in the fourth quarter were pulled forward by clients and closed early in the third quarter.
Okay, so they robbed Peter to pay Paul.
Essentially. The Q3 optics looked spectacular, but it effectively cannibalized the revenue pipeline for the upcoming quarter.
How much of that is just simple timing variation versus an actual shift in the macro environment? Are we seeing the distressed market fundamentally change as interest rates shift?
The restructuring market is incredibly sensitive to the cost of capital, and we are definitively entering a transitional phase.
Okay.
As inflation cools and central banks begin to lower interest rates, capital becomes more abundant.
And less expensive.
Exactly. So companies that might have defaulted under punishingly high rates can suddenly refinance their debt or find alternative rescue capital.
Ah, so fewer bankruptcies.
Right. The distressed market is subsequently entering what management characterizes as an ebb period. The peak of the bankruptcy cycle we witnessed over the last couple of years is normalizing, meaning Q4 restructuring revenues are expected to reverse their typical seasonal pattern and decline.
So the bear hedge is ebbing, but the bull M&A engine is only in the third inning.
Right.
What does a firm do with over $1 billion in cash when one side of their business starts to cool down? They seem to be aggressively filling in their geographic white space, particularly in Europe.
They've been very busy there.
Management actually stated on the call that they believe their European business could eventually rival the size of their entire U.S. corporate finance arm.
Their capital allocation strategy is highly disciplined. They prioritize strategic acquisitions that offer a perfect cultural fit over, say, aggressive stock buybacks or oversized dividends.
Makes sense.
In just the final stretch of this fiscal year, they executed two major European deals. The first is Audier Partners in France. Houlihan Lokey acquired a 51% controlling interest in this prominent mid-cap advisory firm.
And that adds some serious headcount.
It adds over 50 professionals, immediately creating an 80-person hub in Paris.
Which is odd that they've historically been underweight in, right?
Yeah.
France is the home turf for a couple of their major European competitors like Rothschild.
Establishing a stronghold in a highly localized market like France requires acquiring established local trust. You cannot simply open an office in Paris and expect French mid-market founders to hand over their life's work to an American bank.
Right, they want to deal with locals.
By acquiring Audier, they buy that local credibility overnight. Management anticipates that this specific hub will create network effects that lift all boats across their entire European operation.
And they made another acquisition right after that.
Yes. The second key acquisition followed in January 2026 with Mellum Capital.
Yeah.
That brought in an 11-person team across Germany and the UK, specifically to build out the Capital Solutions Group's real estate capital advisory capabilities.
I want to focus on how they actually compete globally, because they don't just expand by putting a generic healthcare team or a manufacturing team in a new city. They utilize a strategy of granular subsectorization.
It's incredibly specific.
What does that actually look like in practice when they're pitching a client?
It looks like an overwhelming information advantage. Instead of broad industry coverage, Houlihan Lokey deploys deeply specialized vertical teams across roughly 200 incredibly specific global subsectors.
200.
Yes. For instance, they don't just have a pharmaceutical desk. They differentiate between a banker who specializes in mature pharmaceutical marketing and one who specializes in new pharmaceutical marketing.
That is granular.
If you are a founder selling a highly niche aerospace fastener manufacturing business, Houlihan Lokey isn't sending you a general industrial banker. They are sending you the specific banker who has sold 10 other aerospace fastener companies in the last 3 years.
It creates a massive information asymmetry. If you're a generalist bulge bracket bank trying to dip into the mid-market, you simply can't compete with someone who knows the exact buyers, the exact multiples, and the exact hidden risks for a subsector that microscopic.
You really can't. The firm accumulates a level of pattern recognition that is nearly impossible to replicate from the outside. They have visibility into the private dynamics of thousands of mid-market deals globally.
Here's where it gets really interesting. Because that pattern recognition isn't just living in the minds of their bankers anymore. Let's look at their move into artificial intelligence.
This is the big pivot.
Because they execute more transactions, more restructurings, and more valuations than almost anyone else in this tier, they are sitting on a 20-year treasure trove of unstructured M&A data. What makes their specific data so much more valuable than what a generic AI model already has access to?
Think about it this way. An off-the-shelf AI model trained on the public internet can write a polite email, or it can summarize a Wikipedia page, but it has zero insight into the intricate private deal dynamics of a mid-market buyout from 2018.
Because that data was never public.
Exactly. The real currency in the age of AI is proprietary closed system data. Houlihan Lokey possesses decades of highly confidential, highly specific transaction data. We're talking financial models, buyer behaviors, successful negotiation terms, and failed deal postmortems. No AI developer can scrape that from the public web.
And they are officially turning that data into a product. In November 2025, they launched an early-stage initiative called DataBank. The explicit goal is to take this massive proprietary data set and monetize it by providing it directly to clients. But beyond external products, they're also using AI internally to completely rewire how their own bankers work.
This is where it changes the industry.
In a recent interview, their chief information officer, Alan Fazio, detailed the development of an AI orchestration layer. They are training a centralized model to automate what they call 100-level tasks.
Those 100-level tasks are the foundational building blocks of investment banking. We're talking about massive data extraction, scanning through hundreds of pages of messy PDF contracts in a data room just to find specific EBITDA adjustments.
Or populating basic financial models.
Right. Traditionally, this is the exact grunt work that falls to 22-year-old junior analysts right out of college.
Oh man, anyone who has ever worked in finance knows exactly what we are talking about here.
The rite of passage.
Remember staring at a glowing Excel spreadsheet at 3 a.m., surviving on cold coffee, manually typing numbers from a scanned document into a model? That rite of passage is effectively being automated.
It's gone.
The productivity implications are staggering. A junior banker no longer spends 40 hours manually pulling those numbers. The AI orchestration layer does it in seconds.
That automation directly drives margin efficiency. The firm can process a higher volume of deals without linearly scaling their headcount. However, it also fundamentally alters the baseline skill requirements for those junior hires.
Because you don't need data monkeys anymore.
Exactly. The firm no longer needs human calculators. They need junior bankers who can instantly interpret the AI's output, spot hallucinations, and apply high-level strategic thinking much earlier in their careers than previously expected.
If you are managing a team right now in any data-heavy industry, this is the exact operational hurdle you're likely facing. You want the efficiency of AI, but the risks are terrifying.
Very terrifying.
Investment banking is a heavily regulated industry. You've got strict data retention laws, compliance firewalls, safe harbor rules. How do they deploy an AI orchestration layer that listens to client meetings without accidentally breaching those massive compliance walls?
That is the defining challenge of this pivot. Ensuring that an AI system doesn't inadvertently leak confidential, material, non-public information across internal deal teams.
The legal nightmare.
If the AI learns from a highly confidential restructuring deal in Team A and then accidentally uses that knowledge to assist a corporate finance deal in Team B that is a catastrophic regulatory breach,
Right.
navigating those compliance walls while still allowing the AI to be genuinely useful is really uncharted territory for the entire sector.
So what does this all mean? We have a firm dominating 98% of global deal volume in the middle market. They have a brilliant, stress-tested, bull-bear natural hedge. They're sitting on a fortress balance sheet, expanding aggressively across Europe, and building a proprietary AI moat out of 20 years of private transaction data.
It sounds perfect.
It does. If the fundamental architecture is this strong, why are market analysts assigning the stock a hopeless reading right now?
Well, it illustrates a critical difference between evaluating a great company and evaluating a stock price at a specific moment in time. The analyst consensus is that Houlihan Lokey is currently priced for perfection. When you look at the valuation math, the stock is trading at a premium forward price-to-earnings ratio of roughly 24x.
And to give you a sense of scale on that valuation, analysts are pointing directly at a close mid-market peer, Piper Sandler, ticker PIPR. Piper Sandler is currently trading at a significantly cheaper 22x forward PE.
But it isn't just the multiple.
Right. According to the research reports, Piper is currently demonstrating higher managing director productivity. They are annualizing roughly $10 million in revenue per managing director.
Compared to Houlihan Lokey's $8 million per MD.
Exactly. Why is there a $2 million gap in productivity between two similar firms?
That discrepancy is largely a byproduct of the culture we discussed earlier. Houlihan Lokey's strict 2% cap on individual revenue concentration, it limits the massive blowout years a single star banker might have at a place like Piper Sandler.
So you're trading peak individual productivity for institutional stability.
Precisely. But when equity analysts see a competitor generating more revenue per senior banker at a cheaper valuation multiple, their immediate reflex is to advise caution and wait for a better entry point.
Makes sense.
Additionally, the market is actively pricing in those restructuring headwinds. Because Q3 pulled so many distressed deals forward, the Q4 year-over-year growth comparisons are mathematically guaranteed to look artificially weak.
There is also a structural vulnerability in how they generate their cash flow that analysts are watching closely, and that's their complete and fee dependency. In both the corporate finance and restructuring segments, the vast majority of their revenue comes from completion fees.
Compare that to a traditional management consulting firm, which operates on a steady, predictable monthly retainer model.
Right.
In investment banking, you might work on a complex merger for 9 months. If a sudden macroeconomic shock, an unexpected regulatory block, or a geopolitical crisis kills that deal at the 1-yard line, the firm only gets to keep the initial retainer and a few minor progress fees.
They completely lose the massive back-end windfall that actually drives profitability.
Exactly. And when your stock is priced at a premium 24x multiple, the market has zero tolerance for deals falling through at the finish line.
So, synthesizing all of this, the final verdict from the analyst community is that Houlihan Lokey acts as a defensive compounder.
Yes.
The long-term catalyst, the pent-up M&A recovery, The margin expansions from the AI orchestration layer, the aggressive European white space acquisitions, they're all incredibly potent. But in the near term, with the restructuring segment entering an ebb period and the valuation stretch relative to highly productive peers, the consensus is to simply hold and wait for the mechanics to play out.
That's the read on the street.
Well, for anyone navigating modern markets, understanding this fundamental architecture really helps you grasp how true financial resilience is engineered from the ground up. You are looking at the architect of the middle market, a firm that realized the real institutional wealth isn't always in fighting over the 1% of mega deals on the front page of the financial papers.
No, it's in the volume.
It's in quietly, efficiently executing thousands of niche, subsector deals globally. They've effectively hedged against recessions, insulated themselves from star banker egos, and are now betting big that their proprietary transaction data will become the ultimate AI moat.
The structural resilience of the firm is undeniable. But looking toward the future, their aggressive integration of AI introduces a fascinating structural paradox. And not just for them, but for the entire financial industry.
How so?
Think about the Wall Street apprenticeship model. For decades, the way you built the deep, instinctive financial intuition required to become an elite senior managing director was precisely by grinding through those 100-level tasks.
By doing the manual labor.
Exactly. You learned how a deal actually works by manually building the models at 2 a.m., finding the hidden flaws in a messy data room. If Houlihan Lokey's AI successfully automates all that foundational grunt work, how does the next generation of analysts build that foundational muscle memory?
That's a huge point.
If they never do the manual labor, how do they develop the elite intuition required to advise clients 10 years from now? Does the immediate, highly profitable push for AI margin efficiency risk creating a lost generation of senior talent down the line?
That is definitely something to chew on.
Risk defined, portfolio protected.